Greetings. Welcome to Perceptron Fiscal Fourth Quarter and Full Year 2020 Conference Call. At this time, all participants are in listen-only mode. The question and answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star zero on your telephone keypad. Please note this conference is being recorded. At this time, I'll turn the conference over to Bill Rochline, Interim CFO. Mr. Rochline, you may begin.
Thank you. Good morning and welcome to Perceptron's investor call and webcast to discuss the company's financial results for the fourth quarter of fiscal 2020. My name is Bill Rochline and I am Perceptron's Interim Chief Financial Officer. Joining me on the call today is Jay Freeland, Chairman of the Board and Interim Chief Executive Officer. Before the market opened today, Perceptron issued its fourth quarter earnings release, which is available on its website at investors.perceptron.com. We will begin the call with our prepared remarks and then open the call up for questions. However, before we begin today's call, it's my responsibility to inform you that some of the material that we will be discussing today constitutes forward-looking information under the meaning of the Private Securities Litigation Reform Act. Any forward-looking statements that are based upon information believed to be true as of today. Actual results may differ materially. For discussion of some of the factors that could cause actual results to differ, please refer to the Risk Factors section of our latest annual and quarterly filings with the SEC. Additionally, please note that you can find a reconciliation of the historical non-GAAP financial measures discussed during our call in the press release issued today. Unless otherwise noted, comments are in U.S. dollars, and references to years will be fiscal years, which end on June 30th. I will now turn the call over to Jay.
Thanks, Bill, and good morning, everybody. Before the market opened this morning, we issued two press releases, one announcing our fiscal fourth quarter results, and the other announcing that Perceptron has entered into a definitive agreement to be acquired by Atlas Copco for $7 a share. The offer from Atlas represents a 71% premium to our closing price on Friday, September 25th, and a 192% premium from our low point during this calendar year. Since our inception nearly 40 years ago, Perceptron has grown to become a leading metrology brand, one recognized for its ability to provide advanced, flexible automation and quality control solutions to a diverse mix of global customers. After being appointed interim CEO in November of 2019, I, along with our interim CFO, Bill Rochline, and our board of directors, invested significant time and resources to determine the best strategic path forward for Perceptron, whether as a standalone company or alternatively as part of a larger organization. As we assessed the business landscape, a couple of critical issues became clear. First, while Perceptron has a strong position in automated metrology and robot guidance, we knew that we needed to grow over time to compete effectively versus better capitalized, more efficient global competitors. While the company has been highly successful historically, our smaller size had become a visible hurdle to long-term sustainable growth. Second, it became clear that we needed to lessen our reliance on the automotive industry and expand into other industries that have a known and demonstrated need for the solutions we are most known for. That type of expansion would take a meaningful investment of time and resources to ensure it was executed well over the next several years. So when the opportunity arose for a business combination with a global strategic partner like Atlas Copco, who recognized the long-term unrealized value evident in our business, as reflected by a compelling offer at a significant premium, it became clear that the best possible outcome for Perceptron and its shareholders was to move forward with them. Founded more than 150 years ago, Atlas Copco is a global industrial technology leader. Based in Stockholm, Sweden, they had approximately $11 billion in sales last year. Atlas Copco is traded on the Stockholm Stock Exchange with a market value of approximately $48 billion. Their recent acquisition of IsraVision, a global provider of machine vision solutions, made the addition of Perceptron to broaden the portfolio compelling from both a market and a technical fit. The deal is subject to CFIUS approval, regulatory approval in certain European countries, shareholder approval in the U.S., and other customary closing conditions. We expect to close during the calendar fourth quarter of this year, 2020, and I'm excited by the opportunities this presents for the company and believe it is a great outcome for our employees and shareholders alike. Switching gears now to our fiscal fourth quarter results, despite the lingering impact of COVID-19, our performance exceeded our internal expectations. Bookings in the quarter increased more than 62% on a sequential basis during the period, driven by increased customer demand in Asia and Europe. Operations in Asia had resumed by the start of the quarter, and Europe was recovering from a COVID-19-induced business slowdown. As a result, we were able to capitalize on pent-up customer demand, a trend that continued into the fiscal first quarter and enabled us to grow total backlog in Q4 more than 16% sequentially. Since the Americas didn't reopen until around mid-May, they lagged the recovery in Europe and Asia. We are looking for that region to improve the growth rate to levels comparable to that of Europe and Asia during the first half of fiscal 2021. Global market conditions are improving despite headwinds from COVID-19. While we have seen a handful of project delays, we have not experienced any project cancellations. As stated last quarter, projects that were already funded appear to be moving forward, as do those that have been partially funded. We are closely monitoring projects with funding targeted for the second half of our fiscal year 2021, but have not witnessed any changes to their status at this point. While we anticipate a continued recovery across our markets as fiscal 2021 unfolds, we have prepared the business for a variety of scenarios. The proactive cost reductions we executed in February, which included a reduction in force, allowed us to take improved control over our cost structure in advance of the COVID-related slowing in our business. Fiscal Q4 was the first quarter that we received the full benefit of those actions, driving material improvements in both our gross and operating margins. The actions we took will remain in effect for the foreseeable future, and as a result, we anticipate continued strengthening of our organizational cost structure. Likewise, when we implemented the reduction, we executed it at the level we thought was necessary to support the business over both the near and medium term, so we do not anticipate taking additional cost actions at this time. Fortunately, unlike fiscal Q3, where we were focused on weathering the early stages of the COVID crisis, the cost actions we took in the last quarter allowed us to spend the fourth quarter helping our customers during a transitional period while pivoting back toward a focus on growth within both new and existing markets. While no one can fully anticipate the lingering effects of COVID on the marketplace, all indications for the coming quarters are favorable. I'm excited for our company with the pending acquisition by Atlas Copco, and I look forward to the successful closing of the transaction, along with a successful integration of our two businesses. And as always, I want to thank the entire Perceptron team for their hard work and diligence in navigating these unprecedented times. I will now turn the call over to Bill.
Thanks, Jay. Total sales in the fiscal fourth quarter were $12.6 million, close to flat sequentially from the previous quarter, and down $5.6 million or 31% from Q4 the prior year. On a sequential basis by geography, sales in Asia rose $1.1 million, sales in Europe rose $0.3 million, and sales in the Americas declined by $1.5 million. As you may recall, quarantine orders related to COVID-19 were lifted much earlier in Asia than they were in the Americas region. On a year-over-year basis, quarterly sales were down $5.6 million, with the majority of the decline coming from the Americas, down $2.6 million or 48%, and Europe down $2.0 million or 23%. Total bookings in the fiscal fourth quarter were $17.6 million, up $6.7 million or 61% sequentially from the previous quarter, and down $3.2 million or 15% from Q4 the prior year. On a sequential basis by geography, bookings in Asia bounced back the strongest, increasing $4.3 million or 184%. Europe increased $1.4 million or 22%, and Americas increased $1 million or 46%. On a year-over-year basis, Asia bookings increased $2.4 million, Europe increased $0.1 million, while the Americas declined by $5.7 million. Gross profit as a percent of sales for the fiscal fourth quarter were 37.5%, up 270 basis points from the prior year and up 510 basis points from Q4 of the prior year. On a sequential basis, gross margin increased due in part to the reclass of underutilized project engineer labor costs of $800,000 to G&A as a result of the COVID-19 shelter-in-place orders, as well as lower ongoing fixed cost expenses resulting from our restructuring in February 2020. On a year-over-year basis, gross margin increased due to both changes in the revenue mix and lower fixed manufacturing costs resulting from our restructuring and cost containment activities. Turning to operating expenses, engineering and R&D expenses were $1.2 million in the fiscal fourth quarter, a decrease of approximately $0.3 million compared to the previous quarter, and a decrease of approximately $0.8 million from Q4 of the prior year. The decline in both periods is primarily due to lower labor costs as a result of our third quarter restructuring. Selling, general, and administrative expenses were $4.6 million in the quarter, an increase of $0.6 million from the previous quarter and a decrease of $400,000 from Q4 of the prior year. Excluding the labor cost reclass from cost of goods sold in the quarter, expenses declined by $0.2 million sequentially, in line with expectations outlined in our last call. Income taxes for the quarter were $0.5 million, reflective of NOL and other valuation allowances taken for certain geographies. Net loss for the quarter was $1.4 million, or 15 cents per diluted share, compared with a net loss of $8.4 million, or 87 cents per diluted share in Q4 of the prior year. Adjusted net loss for the quarter, which excludes the impact of severance, impairment, and other charges, was $1.4 million, or 15 cents per diluted share, compared with $0.8 million, or 8 cents per fully diluted share in the prior year comparable period. As of the quarter end, we had $4.8 million in borrowings outstanding and $10.6 million in total cash and cash equivalents globally. Included in our borrowings is a $2.5 million PPP loan, and we intend to submit our loan forgiveness application related to this loan in the current quarter. I would now like to turn the call over to the operator, who will open the call for your questions.
Thank you. We'll now be conducting the question and answer session. If you'd like to ask a question, please press star 1 on your telephone keypad, and a confirmation tone will indicate your line is in the question queue. You may press star 2 if you'd like to remove your question from the queue. For participants that are using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions. Thank you. And our first question is from the line of Greg Palm with Craig-Hallum Capital. Please proceed with your questions.
Yeah, thanks. I guess congrats on the announcement here. I'm not sure what all you can say at this point. I know eventually we'll get some more details, but in terms of the transaction, can you give us a little bit more detail on maybe the background of the process? You know, I guess really specifically what I'm interested in, and I think others are. Were there any other interested parties in here?
Yeah. Hey, good morning, Greg. So I'll go in reverse order. There were other interested parties, which would not be a surprise given the technology portfolio that we have. And, I think, as we made transition into my interim role and Bill's, there were some parties who look at it and said, well, perhaps there's an opportunity here for a good combination with Jay and Bill sitting in the leadership seats right now. And so I did, there were several parties who were interested in it, in the company. And while I'll say that they were all interested parties, for me, and for the rest of the board, Atlas made a very compelling cash offer at a significant premium. And, for us, we have a great leadership position, very strong position in automated metrology and robot guidance, but we certainly needed to create some more scale for the company, right? We were a bit of a niche player. It's a industry that's very quickly becoming managed by multiple large players, and so that made it difficult for us. And I think we wanted to get access to additional end markets for sure. As we've talked before, we had this heavy reliance on automotive, and diversification was going to be a key to doing so. And, Atlas is in all of the spaces that we're currently in, as well as the ones that we were driving the business towards, even as a standalone entity. And so when we looked at, we did a pretty thorough strategic review as a board. We put together what we thought was a compelling strategic path forward as a standalone entity. But the path offered by Atlas was more compelling. And I think it's a really strong tie-up of our technology into their business. Their recent acquisition of ISRA is a good logical connection. There's very little overlap between what the two companies do, but commonality in terms of the types of customers and where in the facilities we are selling and operating. And so the combination of all of those items made this a really good path forward and a great solution for the company longer term.
Yep, that makes a lot of sense. And, it does sound like they're kind of, building out, somewhat of a new vertical here with a couple acquisitions, regulatory approvals. I mean, you wouldn't envision any issues. I mean, I don't think, ISRA competes with Perceptron really at all, but any, regulatory approval concerns on your end or not really?
There are not. Really the three are going to be doing the CFIUS approval. There's some regulatory approval in a couple of European countries that we need to go through. And then obviously the shareholder approval here in the U.S. For the transaction itself. We obviously have looked at it very carefully. We feel very confident, as does Atlas, in the ability of those approvals to be granted. And, they did just go through this with ISRA. And you're right, there is so little overlap between the two businesses that, from our perspective, this should be pretty straightforward. And it's one of the many reasons we think that there's a reasonable chance, more than reasonable chance, that this is going to be closed by the end of the calendar year.
Got it. All right, I'll leave it there. Thanks.
Thanks, Greg.
Thank you. At this time, I'll turn the floor back to Jay Freeland for additional remarks.
Okay, well, thanks everybody for participating in the call this morning. We will look forward to keeping everybody updated as the closing process continues. And as always, I'd like to thank all of you for joining us. I'd like to thank everybody for their support. And of course, one last time, thank the Perceptron team for everything they do. So thanks very much, everybody. Have a good day.
This concludes today's conference. You may disconnect your lines at this time. Thank you for your participation.